Welcome to The Explainer. Today, we're diving headfirst into a topic that, let's be honest, probably affects almost everyone's financial roadmap: housing. We're going to untangle the realities of the mortgage market as we move out of April 2026. If you've been glancing at the headlines, you know the housing market's been an absolute roller coaster lately. But as we look toward the rest of 2026, a totally new reality is setting in. We're going to look at exactly what the data says is coming next and what it actually means for you, whether you're buying, selling, or just holding on to your current home.
Now, to figure out where we're going, we've got to ground ourselves in the absolute latest data. Right now, stepping out of April, the average 30-year fixed mortgage rate is sitting right at 6.38%. This number, this is our anchor today. It's a huge improvement from those scary 7+% peaks we hit back in late 2023. But it also shows a market that's kind of plateaued, right? We all hoped for a steeper drop earlier in the year. But this 6.38% is the baseline reality driving pretty much every real estate decision right now.
So here's our roadmap for this explainer. First, we'll grab a snapshot of April. Then, we'll ask, why are rates stuck? Third, we'll look at the fading lock-in effect. Fourth, the big one, will the market crash? And finally, we'll wrap up with the late 2026 forecasts.
All right, let's jump right into Section 1, the April 2026 snapshot, and how a new era is emerging.
You really have to notice the stark contrast between where we were and where we are now. Think back to the pandemic era. Man, it was a frenzy fueled by ultra-cheap money, right? That led to wild, volatile mortgage rates, essentially a frozen migration because literally no one wanted to give up their sub-3% rate, and some historic, severe affordability challenges. Fast forward to our 2026 market, and it's a completely different vibe. We're seeing stable rates in the mid-sixes. Yeah, it's higher, but the key word here is stable. For your wallet, that means predictability. You can finally budget for a move without the interest rate jumping a full percentage point overnight. Inventory is also finally normalizing in a bunch of regions, especially the Northeast and Midwest. And most importantly, that pandemic-era lock-in effect, it's starting to fade. We are basically transitioning from a market of pure shock and scarcity to a much healthier recalibration.
Moving right along to Section 2, why are rates stuck? It's basically a massive macroeconomic tug-of-war. Let's actually walk through the Federal Reserve's recent behavior, because this brilliantly illustrates the shift in momentum. Back in September 2025, the Fed signaled they were ready to ease up, and the rate cuts began. Everyone was thrilled. By December, we saw our third consecutive cut, and buyers were definitely getting excited. But then, bam! At the January 2026 meeting, the Fed hits pause. They held the federal funds rate steady right at 3.5% to 3.5% just to step back and assess the economy. And then, at the March meeting, they paused again, and that March decision was almost unanimous. So the Fed totally shifted gears from a cutting cycle into this very cautious wait-and-see approach.
So what's going on behind the scenes? It's crucial to understand the complex macroeconomic forces causing this hesitation. Remember, the Fed doesn't directly set mortgage rates, but their policy heavily influences the 10-year Treasury yield, which absolutely dictates your mortgage rate. Right now, there are these competing levers just yanking the economy in different directions. On one hand, you have an easing labor market, which usually pulls rates down. Great. But on the other hand, you've got this sticky inflation that just stubbornly remains above the Fed's 2% target. Add to that the ongoing conflict in the Middle East, which is causing these spikes in oil prices, and the fact that the U.S. economy is honestly still expanding at a really solid clip. It's a perfect macroeconomic tug-of-war, and the Fed is caught smack in the middle. If the labor market weakens quickly, rates could totally drop into the fives. But if inflation stays hot, yep, rates get pushed right back up.
All right, Section 3, fading the lock-in effect and unfreezing supply.
Okay, you have to look at this incredible shifting statistic. For the last few years, the market was basically frozen solid because everyone was sitting on those ultra-cheap mortgages. But as we've moved through 2026, nearly 20% of all outstanding mortgages now carry rates above 6%. And you know what? That share grows with every single new home purchase. What this means, just mathematically, is that the cheap money lock-in is being diluted. We're finally hitting this tipping point where millions of homeowners are no longer trapped by a 3% rate. If life happens, they need to upsize for a growing family, downsize, or relocate for a new job, they're just so much more willing to sell now because their current rate isn't vastly different from today's market rate.
In fact, as of late 2025 and into 2026, the average interest rate on all outstanding mortgages has climbed up to 4.4%. Now, why does 4.4% matter? Because that's the exact same level it was sitting at way back at the end of 2019, right before the whole pandemic cheap money frenzy even started. As this outstanding average slowly climbs to meet current market rates, it's removing one of the biggest bottlenecks the housing market has literally ever faced. Now, it's not going to unleash some massive overnight flood of inventory, but it is slowly and steadily unfreezing the market, allowing transaction volumes to finally breathe again.
Which brings us to Section 4. Will the market crash? Let's address the fears head-on.
It's the elephant in the room, right? Whenever home prices stay this high and rates are hovering in the sixes, people naturally start asking, is a 2008-style housing crash coming in 2026? Are we standing on the edge of a cliff here? Let's address this anxiety directly by looking at what the experts, and more importantly, the fundamental data are actually telling us.
To firmly answer that crash question, we just have to turn to the consensus outlook for the year, which is basically this: flat is the new up. The baseline forecast for 2026 calls for home prices to be essentially flat, projecting a national price appreciation of just 0.5%. So no, we are not seeing a volatile rapid drop like a crash. Now sure, some oversupplied local markets, particularly down in the Sunbelt, might see some modest declines. But nationally, we're looking at a flattening. And frankly, this is exactly how affordability returns to a market. Not through a catastrophic 2008-style correction, but through an extended period of flat home prices while people's incomes rise and mortgage rates gradually fall.
And hey, if you need a little more reassurance that a crash is highly unlikely, just look at the equity data. U.S. mortgage holders are exceptionally healthy today. Equity is at absolute record highs. The average loan-to-value ratio has dropped to just 47%. Think about that for a second, down from 70% a decade ago. Plus, while mortgage debt does represent 70% of all outstanding household debt, delinquency rates remain incredibly low. Even if the labor market softens a bit, the timing of any employment-driven housing distress would likely extend way out into 2027. The foundational stability of the current American homeowner makes a 2008-style crash a very, very remote possibility for 2026.
All right, our final section, number 5. Forecasts for late 2026. The Goldilocks scenario.
Okay, let's lay out the year-end bets from the major institutions side by side. If we stay on this current path, look at where the consensus is drifting. Morgan Stanley is predicting a drop to between 5.5% and 5.75% by mid to late year. Zillow expects rates to ease to around 6.0%. Fannie Mae forecasts a decline to 5.7%. And the Mortgage Bankers Association sees rates sitting at 6.1%. While accurately predicting interest rates is, notoriously difficult, the clear consensus here is a downward drift towards the upper 5s and lower 6s as we close out the year. The extreme highs of 2023 and 2024, those are safely in the rearview mirror.
So, what does that actually mean for market activity? Well, if rates stay in this predictable, balanced range, this just right Goldilocks zone, transaction volumes are finally going to grow. The forecast calls for existing home sales to bump up by about 5%, rising from roughly 4.1 million to 4.25 million sales. We are already seeing purchase mortgage applications running materially higher than they were a year ago. There's just this massive amount of pent-up demand from folks who've put off major life changes for the last 3 years. As rates moderate and inventory rises, all that sideline demand is absolutely going to be unleashed.
Which brings us to the end of our explainer today and leaves you with a pretty big question you have to ask yourself. We've established that 2026 is definitely not about a crash, nor is it a return to that wild pandemic-era boom. It's a brand new era of stability, flatter prices, and slowly easing rates. So how does this new era of stability change your moving plans for 2026? If you've been waiting on the sidelines out of fear or just holding out hope for rates to drop back to 3%, the data's pretty clear. It's time to recalibrate your expectations to this new normal. Evaluate your own situation, look at the math, and decide your next move. Thank you so much for joining me to explore the 2026 mortgage market. Keep learning, and I'll see you next time.